It is up to you and me to protect ourselves. One day the inevitable will happen. If we are smart, we will recognize that historical cycles tend to repeat. By educating ourselves on what to look for, we can ensure we're not caught off guard when a financial crisis hits. We must prepare now so when the storm comes, we won't be swept away with the rest. What triggers the most devastating recessions? Those that go beyond just a bubble bursting and lead to a full-blown financial crisis. Examples include the 2008 crisis, when mortgage delinquency surged by an outstanding 657%, resulting in the collapse of major banks like Lehman Brothers, which had total losses of $609 billion. Or consider the Great Depression, where 25% of the workforce became unemployed, and those who retained their jobs saw pay cuts averaging 42%. Imagine waking up to the stock market crash, watching your investments plummet, and seeing your savings at risk. It sounds terrifying, and it is. But this has happened before, and there are clear warning signs that predict a financial crisis. From asset price bubbles to bank collapses, history provides us clues. In this video, I'll share the key signs that a financial meltdown may be on the horizon and what you can do to protect yourself. But before we dive into this information, this channel is dedicated to providing you with the truth about your finances. As you know, the goal of this YouTube channel is to help you develop your own investing or trading system. We track over 100 indicators to improve our probability of success in the stock market. This channel not only provides these indicators and insights into market psychology, but also shares our recommendations on the overall market, sectors, and individual securities. In this video, we'll cover long-term portfolio positions, medium-term, intermediate positions, and short-term strategies. We're going to give you some actionable recommendations. The first question is, will we see a financial crisis next year or just another recession? After 2 strong years in the stock market, the alarm bells are ringing. There's a real possibility we could see a down year ahead. But the bigger question is whether it will be a run-of-the-mill recession offering a pullback and a great opportunity to buy, or a full-blown financial crisis with devastating global impacts. You must recognize there are 4 phases to an economic cycle or the stock market itself. You will see an accumulation phase where everything stays and nothing goes up too much or too down. And then you will see a growth phase, which we have seen the last 2 years, where the whole stock market is moving upwards. And then we have a distribution phase, where we see a topping of the market followed by a declining phase. And then again, the cycle will repeat itself. The key question is, where are you in this stock market cycle? Where are your assets in this stock market cycle? It's important to recognize the difference between a recession and a financial crisis. A recession typically involves a slowdown in economic activity, marked by 2 consecutive quarters of negative GDP growth. The stock market goes down for 6 months to 1 year, and then it starts recuperating. That's what we call a recession. We get a pullback to buy into this market. In contrast, a financial crisis is more severe, leading to a collapse in the financial system, as seen in 2008. A financial crisis is much more dramatic. It hurts more because it goes down a lot and it just doesn't go up. Not only that, but we could see a financial crisis last a year or 2 years, where the market just goes lower. This is not unheard of. So for next year, we get either a recession or a financial crisis. We're trying to figure out which one are we going to get. Do we buy on the pullbacks for a recession, or do we wait longer for a financial crisis to pass? To understand this better, we need to differentiate between a bubble bursting and a full-scale economic crisis. A bubble burst, like the dot-com crash, occurs when overvalued market corrects themselves, leading to profit taking before the market eventually moves forward. However, a financial crisis like the one in 2008 is deeper, more systematic collapse that affects not just the stock market, but the global economy as a whole. In this video, we'll explore the warning signs of an upcoming financial crisis and how you can spot the indicators that suggest whether we're headed for a typical recession or something far more catastrophic. Recession versus financial crisis. Bubble burst. This happens when investors become overvalued and eventually collapse. Prices keep rising and there's widespread sentiment that they will never come down. Investors are overly optimistic and valuations lose touch with reality. For the last 2 years, we have done very well on the long side in this market. We know sooner or later there will be a bubble burst where there's time to take our profits and also get ready for an intermediate term buyback. A recession. This occurs when the economy experiences a significant downturn leading to widespread negative growth. However, when both a bubble burst and a recession happen simultaneously, it triggers a financial crisis, a situation where everything collapses and nothing can prop up the system. So if you get a bubble burst, that's okay. We could live with that. 6 months, 1 year, the market goes lower, and the next year it follows. You get a recession by itself. You can live with that. They lower interest rates. We come out of recession. Everything is good. We get a bubble burst and a recession. And if you throw in problems with margin or debt or loans, even a bigger financial crisis will occur. An easy example of this is what happened in real estate during the Great Depression of 1929. People were buying stocks convinced that there was endless money to be made and no risk of price dropping. This type of overconfidence, especially fueled by debt, is often the predecessor to a financial crisis. The key difference between a bubble and a financial crisis is debt fueled buying. It's not just about throwing cash into stocks or homes, but when excessive borrowing drives the market, when the bubble bursts and asset values plummet, those heavily leveraged buyers find themselves unable to repay their loans or maintain payments on their investments. The tipping point for a financial crisis occurs when confidence shifts suddenly. Buyers dry up, and when everyone owns an asset that nobody wants, values cash. One of the clearest signs when everyone starts saying, invest in this, gold, Bitcoin, tech, AI, real estate, it will only go up and you can borrow to buy it. This belief with values will never fall creates a dangerous environment. When people encourage borrowing to fuel investment, it often signals an impending crash. And when even the least informed investors are jumping in, pouring all their money into a hot market idea, it's a reliable sign that the bubble is about to burst. Recognizing an asset bubble isn't as hard as it seems. You just need to watch for these telltale signs. Many sentiment indicators will help you understand investor sentiment, which we have many indicators explained on this channel. The autonomy of a financial crisis involves several key factors. Asset inflation. There's a bubble where assets like stocks, real estate, or commodities become highly overvalued. Prices are far beyond their actual worth, driving by excessive optimism. Overconfidence. Investors believe the market will only keep going up, fostering a mindset that the high valuations will never fall. This creates false sense of security, encouraging more risky taking. Debit fueled buying. The dangerous part begins when people start borrowing heavily to buy these inflated assets, thinking they'll continue to rise. This debt amplifies the risk because it's not just money people have, it's money they owe. Sudden shift in confidence. At some point, there's a decisive shift in sentiment. Confidence collapses and buyers disappear. When there are no buyers left to support the high prices, asset value plummets. This combination, overvalued assets, overconfidence, debit-driven buying, and a sudden drop in confidence is what leads to a financial crisis. Overvaluation. This back to 1999 when everyone was buying dot-com companies despite the fact that many of these companies had no profits. People were chatting in coffee shops and bars, sharing secret tips about the next big investment and pouring money into these ventures. It was clear that the fundamentals for investing in these companies were lacking. This should have been a signal to most investors that it wasn't a good idea to buy them. The warning signs were often hidden in plain sight, yet many ignored them in the rush to profit. The leading economic index, LEI, for the U.S. is a composite index developed by the Conference Board to forecast future economic activity and provides insight into potential turning points in the economy. It is designed to predict the direction of the economy over the next few months, usually about 6 to 9 months ahead. The LEI consists of 10 economic indicators, of which is sensitive to changes in the economic cycle. These indicators are combined to give an overall picture of the economy, likely future performance. The LEI is widely used by economists, policymakers, and investors to anticipate economic slowdown or recoveries. A rising LEI typically indicates economic growth ahead, while a falling LEI suggests the possibility of an economic slowdown or recession. The 10 components of an LEI includes data points like unemployment claims, new orders for goods, building permits, and stock prices, among others. These components are chosen because they are thought to change before the broader economy does, making them useful for forecasting. This index helps both businesses and investors plan for future economic conditions and adjust their strategies accordingly. The 10 components of the leading economic index for the U.S. are average weekly hours in manufacturing, average weekly initial claims for unemployment insurance, manufacturers' new orders for consumer goods and materials, ISM index of new orders, manufacturer new orders for non-defense capital goods excluding aircraft orders, building permits for new private housing units, S&P 500 index of stock prices, leading credit index, interest rate spread, 10-year treasury bonds minus the federal funds rate, average consumer expectations for business conditions. All that saying this, a picture is worth 1,000 words. And we are very neutral at this point, thus leading us to believe, based on this chart, we can just have a pullback where stocks are overvalued, they come lower, you buy into them when they are lower, and then you ride up the next cycle of the bull market. We will be helping you on this channel, guiding you when to get in and when to get out. But based on this chart, we will not see a full-blown recession coming. These are cycles of economic upturns and downturns. By studying historical cycles, we can observe that they tend to repeat over time. Even though speculation and market exuberance can persist for years, speculation often fuels crashes. When debt is involved, whether it's credit cards, mortgages, or margins, it can transform a downturn into a full-blown financial crisis. This pattern repeats itself time and time again. Speculation drives the crash, debit worsens, and the lack of oversight makes the situation even more severe. The question becomes, can we predict the next financial crisis? There will be warning signs. In the next few videos, we'll be reviewing more of those signs. We'll also dive into historical events like the 1920s crash and the 2008 crisis, examining what warning signs were present. The good news is I don't foresee a full-blown financial crisis, but I do expect a pullback. You should be preparing by accumulating cash for the inevitable market downturn, though not necessarily for the next financial crisis. These downturns can last anywhere from 3 months to 1 year, which gives you ample opportunity to buy on the pullbacks. But this is not buy on the pullbacks like the last 2 years. Once the panic sets in, the market collapses, and it always does. The cycle of a financial crisis follows a predictable pattern. What begins with overvaluation and speculative bubble inevitably leads to panic when investors realize that the market cannot sustain its inflated values. The final stage is the crash as fear spreads, confidence vanishes, and mass sell-off occurs, deepening the economic downturn. This cycle has repeated throughout history from the Great Depression to the 2008 financial crisis, always following a similar trajectory. Preparing for the next crisis is not a question of if, but when. History gives us clues, but it's up to us to act on those clues. Financial literacy is the key to protecting yourself from becoming a victim. By recognizing the warning signs, learning from past crises, and staying proactive, we can navigate the inevitable downturns and shield ourselves from a full impact of the next financial crisis. You know the catchphrase. Study it, analyze it, adapt it. Peace.